Hi, I'm Giuseppe Incarnato, Chairman and CEO IGI Investimenti Group. Welcome to Private Equity Lesson 2. Leveraged buyout, LBO, refers to a strategy of making equity investments as part of a transaction in which a company, business unit, or business assets is acquired from the current shareholders, typically with the use of financial leverage. The companies involved in these transactions are typically mature and generate operating cash flows. Private equity firms view target companies as either platform companies, which have sufficient scale and a successful business model to act as a standalone entity, or as add-on, tuck-in, bolt-on acquisitions, which would include companies with insufficient scale or other deficits. Leveraged buyouts involve a financial sponsor agreeing to an acquisition without itself committing all the capital required for the acquisition. To do this, the financial sponsor will raise acquisition debt, which looks to the cash flows of the acquisition target to make interest and principal payments. Acquisition debt in an LBO is often non-recourse to the financial sponsor and has no claim on other investments managed by the financial sponsor. Therefore, an LBO transaction's financial structure is particularly attractive to a fund's limited partners, allowing them the benefits of leverage, but limiting the degree of recourse of that leverage. This kind of financing structure leverage benefits an LBO's financial sponsor in two ways. 1. The investor only needs to provide a fraction of the capital for the acquisition, and, 2, the returns to the investor will be enhanced, as long as the return on assets exceeds the cost of the debt. As a percentage of the purchase price for a leverage buyout target, the amount of debt used to finance a transaction varies according to the financial condition and history of the acquisition target, market conditions, the willingness of lenders to extend credit, both to the LBO's financial sponsors and the company to be acquired, as well as the interest costs and the ability of the company to cover those costs. Historically, the debt portion of a LBO will range from 60 to 90% of the purchase price. Between 2000 and 2005, debt averaged between 59.4% and 67.9% of total purchase price for LBOs in the United States. A private equity fund, ABC Capital II, borrows $9 billion from a bank or other lender. To this, it adds $2 billion of equity, money from its own partners and from limited partners. With this $11 billion, it buys all the shares of an underperforming company, XYZ Industrial, after due diligence, i.e. checking the books. It replaces the senior management in XYZ Industrial, with others who set out to streamline it. The workforce is reduced, some assets are sold off, etc. The objective is to increase the valuation of the company for an early sale. The stock market is experiencing a bull market, and XYZ Industrial is sold 2 years after the buyout for $13 billion, yielding a profit of $2 billion. The original loan can now be paid off with interest of, say, $0.5 billion. The remaining profit of $1.5 billion is shared among the partners. Taxation of such gains is at the capital gains tax rates, which in the United States are lower than ordinary income tax rates. Note that part of that profit results from turning the company around, and part results from the general increase in share prices in a buoyant stock market, the latter often being the greater component. The lenders, the people who put up the $9 billion in the example, can insure against default by syndicating the loan to spread the risk, or by buying credit default swaps, CDSs, or selling collateralized debt obligations, CDOs, from / to other institutions. Often the loan/equity, $11 billion in the example, is not paid off after the sale, but left on the books of the company, XYZ Industrial, for it to pay off over time. This can be advantageous since the interest is largely offsettable against the profits of the company, thus reducing, or even eliminating, tax. Most buyout deals are much smaller. The global average purchase in 2013 was $89 million, for example. The target company, XYZ Industrials here, does not have to be floated on the stock market. Most buyout exits after 2000 are not IPOs. Buyout operations can go wrong, and in such cases, the loss is increased by leverage, just as the profit is if all goes well. For large deals, private equity investors often invest together in a syndicate, in order to jointly benefit from exposure diversification, complementary investor information and skills, and heightened connectivity for future investments.